Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week we're going to take a hard look at the recent announcements of the Reserve Bank of India to try and somehow stir the corporate bond market, the comatose corporate bond market to life. And to do that, I have with me none other than the author of not just one, but a series of reports on the corporate bond market, the former Deputy Governor of the Reserve Bank of India, Harun Rashid Khan, and NS Venkatesh, presently ED with the Lakshmi Vilas Bank, but more importantly from the perspective of this program, Chairman of the Fixed Income and Money Market Dealers Association of India, FIMDA. Welcome to the show, Harun. Venkatesh. Let me start with you, Harun. As the main author of, as I said, a number of reports on the corporate bond market, incidentally, how many reports were you responsible for during your 30-odd years with the Reserve Bank of India? Would you say that this is the most seminal change as far as the corporate bond market is concerned, and why?
Yeah, Mythili, if you can just very brief background, we have been talking about corporate bonds since one should say ages, and it's not that things have not happened. For example, if you see 2-3 years back when there was 8 to 9 trillion outstanding, now outstanding is 21 trillion, and daily volumes were 300-400 crores, now they are around 2,500 to 3,000 crores. So it is not that corporate bond market has not developed, but the point is that it has not developed to the extent it should do in the Indian context, where you have huge requirement in terms of infrastructure, huge requirement in terms of risk diversification, huge requirement in terms of pricing and cutting down the leverage of banks. So I think it has been the effort of both government and regulators, including Reserve Bank and SEBI, to see that we take further steps to further boost this market, and this is an offshoot of the discussions which have happened in FSDC last 3-4 years and FSDC subcommittee. So pursuant to that, this committee was set up. The whole idea of this committee is not to write a tome, but to crystallize what all have gone in the past and what all need to be done in a time frame which can be implemented. So that is the background and focus of this report. And I think, as you have said, quite a significant things have been announced, and few more I think going forward will be announced, and I believe there will be very significant step in boosting corporate debt market in India.
Venkatesh, you've been at the receiving end of the RBI's slow and steady moves. Calibrated moves is how the former Governor Y.V. Reddy described the RBI's moves. So would you concur with Harun that with the latest package, RBI has unleashed a slew of measures that really have the potential to make a difference to the corporate bond market? Or are there a number of missing links that you still feel are required before we get the necessary traction?
Yeah, I definitely agree with Kansab when he said that it is a continuous process of continuous improvements, in the sense that essentially depending upon the requirements through which the economy is passing through, I think the fine tuning needs to be done as far as the regulations also have to be done, so that it is like a way in which ease of doing business, ease of raising money for the corporates, all those things are being put into place. So we have seen this from 1995 onwards, where Dr. Patil committee report had started. I think from where we started, now I do agree with Kansab that essentially the corporate bond market has come up a long way. This set of measures with which Dr. Raghuram Rajan has announced based on Khan committee report is a further set of improvements that they are trying to do for deepening the corporate bond market, improving the transparency, and also improving the underlying liquidity of the corporate bond market. So to that much extent, it is a process continuum, I would say. It's a journey. It's not a destination. It's a continuous journey which is happening, and I definitely welcome the steps that have been brought in, one is the intent of Reserve Bank of India to accept the corporate bonds as an eligible security for LAF by the banks. Second, the announcements that the large corporates will have to go to the market for borrowing above a cutoff limit. The third one about the partial credit enhancements that have come in. I think that these are all, I would say, really a good sort of set of measures which will push the corporate bond market into the next trajectory.
Harun, Venkatesh did not answer my question about what he thinks is the missing links. But if I were to ask you, which are the most 3 significant measures in the package announced by the RBI, what would they be and why? And are there any significant missing links that still need to be filled in? Harun?
No, actually, if you have seen our report, we have put it in 7 sections, starting from issuer to investor to instruments to innovations and incentives, infrastructure and intermediaries. I think
the 7 I's.
Yeah, 7 I's. So the two important innovations or incentives or disincentives for nudging thing is, one is this enhanced partial credit enhancement, which has been raised from 20% to 50%, which is very, very significant. And as you know, we have been for a long time, we have taken the position, and rightly so, that corporate debt market cannot be supported by banks, otherwise it becomes a bond market. But given the reality that we need to give a nudge to this market so that there is a diversification and part of the borrowing corporates go to the market, we have to bring in the banks at least in the nascent stage. So the enhancement of partial credit this expansion of that partial credit enhancement framework is one major step. The other step is very critical, is about what you have Venkatesh just now said, our willingness to take forward corporate bond as a LAF eligible for RBI's repo operations. And of course, very, very critical is that now corporates, certain percentage of incremental borrowing, they have to necessarily go to the market in a phased manner starting from the next year. I think these are three important measures.
Okay, we'll go into each of these at length a little later in the program. But Venkatesh, what do you think the move to allow foreign portfolio investors access to the NDS OM platform and to trade directly in corporate bonds, will these increase the interest of FPIs in corporate bonds? Because the fact is that of the present limit, about 51 billion, only about 65% has been taken up, unlike in the case of GSECs. So do you think these measures will increase the appetite of FPIs in corporate bonds?
See, essentially on the corporate bonds for the FPIs, they have said that they can deal directly without the intermediation of the brokers. That is one thing which has come out. On the NDS home, it is essentially onto the government securities which RBI has allowed, because it is again, I would say, a fine tuning of the mechanism which is there, where essentially they announced that the constituent can actually deal directly into the NDS home for the domestic players. So the same thing they have now extended to the FPI, saying that if they are the constituent SGL account holders through let us say the foreign banks and the other banks which are dealing with them, then maybe to the extent of the risk management and the limits which have been set by the principal banker, I think they should be able to deal it. Two things can happen. One is essentially like if the FPIs have a local office or an India-based office sort of thing, then maybe they can start dealing into that. The only issue here is the intraday trade can happen, because they can buy and sell in the intraday trade using the NDS home. But if you look at, let us say, a large portfolio investor, foreign portfolio investor, like let us say a sovereign wealth fund or a large asset manager with an India dedicated fund sitting outside the country, his requirements could be quite large. And to that much extent, I think he will definitely again look at the custodial banks to give him a support. Over a period of time when the market really develops, then maybe he should also put a India dedicated dealer into his desk for them to access the NDS home within the risk limits the custodial banks or the principal banker sets for him. But it's a welcome move. It's a streamlining and a welcome move for the FPI to see the transparency of the market using the NDS home for them to take informed decisions.
Harun, one of the biggest problems in the corporate bond market really has been the lack of liquidity. Will allowing brokers to do repos in the corporate bonds and act as market makers make a difference? And also, the RBI is reportedly considering accepting corporate bonds as eligible collateral for its liquidity adjustment facility, LAF. How wise is this? I know central banks in developed countries do this, but that was in response to very exceptional circumstances immediately after the collapse of Lehman, when they had to pump in money and did not have the instruments. The position in India is quite different. Banks have enough and more of government securities, so where is the need to risk the integrity of the RBI's balance sheet by taking on corporate bonds, however blue chip? In fact, this comes at a time when the RBI has been resisting use of its reserve funds on the grounds that it will dilute the RBI's balance sheet. So isn't it strange that it's now contemplating doing just that with corporate bonds?
Let me quickly first respond to your first question about brokers being allowed, market making brokers being allowed access to repo. So far we have only allowed regulated entities. But the point is, if you want to provide a market making scheme, there has to be some funding and liquidity support. So that is why we are opening this repo to them. but subject to, they are all on the exchanges, and exchanges have got risk management practices in terms of haircut, in terms of penalty for default. So given that there are robust risk management systems, we felt confident that brokers can be given access to repo to provide funding support. Coming to the second question of LAF eligibility of corporate bond, you are very right that advanced countries under unconventional monetary policy have accepted corporate bonds. There are other countries even without unconventional monetary policy also do accept, central banks accept corporate bonds. In the context of RBI, it is not because of monetary policy requirement or how we are running such of securities. This is purely to provide a regulatory nudge to develop the market. There are upsides and downsides to this proposal. If you take the upsides, for example, as I said, banks and PDs will be encouraged to hold these securities, buy the securities, they will get a funding support, there will be a direct and indirect benefit in terms of adding to the liquidity, and going forward, if liquidity improves, it can be part of their high quality assets, HQLA, in the context of LCR. So these are the benefits you see, but the risks and the downside to it, as you mentioned rightly, could be the risk to the RBI's balance sheet. Because of credit risk, we don't go down to the credit curve. Second risk is that we will be only, maybe initially only AAA, AAA or AA securities only take. Again, it will skew the market. And the third risk possibly could be there is a problem of valuation. So which model to take and how do we value? And fourth also could be the reputation risk, that you do all this, but eventually nothing moves. So you take a reputation risk, credit risk, but things don't move. But then you have to weigh both pros and cons and take a balanced view to see that this market develops critically, because now that you are ensuring that incremental requirement of large borrowers they have to move to the market has to be there, market has to develop. So how do we strike this balance? We strike this balance by 2-3 ways. One is what the report has said. I am not sure whether this is going to be implemented in the same spirit, is that after the market repo and tripartite repo get traction, this should be put in place. In the meantime, enabling legal framework should be put in place. And also we have put suggestions that there has to be very robust and sound risk management practices, whether in terms of duration, maybe initially only overnight, in terms of haircut, in terms of rating. So these measures, parameters have to be kept in view if and when these corporate bonds are accepted as LAF eligible.
Okay, Venkatesh, I think Harun has given a very strong defense of why RBI could possibly take corporate bonds as a collateral for repos. I'm not entirely convinced, but we'll come to that after the break. Please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the latest moves of the RBI to somehow get the corporate bond market, stir it into life. Venkatesh, before the break, Harun, as I said, was discussing why it is not a very big damage to the RBI's balance sheet. But you've struggled with liquidity problems in the corporate bond market from your perch at FIMDA. Do you agree with Harun that it is a risk that is worth taking? It is worth risking the central bank's balance sheet by allowing corporate bonds as collateral for LAF operations?
Yeah, see, essentially it's a market development initiative taken by the Reserve Bank of India. As Kansab has said, it's a nudging of the entire market towards taking the corporate bond as a sort of a security where they can invest. And I would tend to partially agree with that. If you look at the LAF, current LAF also, if you look at it, the amount that is getting pumped in is only to the extent of 1% of the total NDTL in the banking system, and that 1% in any case can be completely taken by means of 0.25 overnight and 0.75 over the term, where essentially the government securities are more than enough for us to, in the banking system, to use that. But having said that, I would say if there is an exit route or a funding or a financing route for the corporate bonds, then the banks and the PDs will definitely warehouse that particular corporate bond and then finance it out of the LAF, so that at least they should be able to then further distribute it down to the retail or to, let us say, the other eligible investors who show an interest into the corporate bond. So one thing is we should see it in light of the measures that are being taken by the Reserve Bank for actually moving the large corporates part of their borrowing requirements into the market. So once it goes into the market, initially maybe the banks and the PDs will subscribe to that, and later it will get distributed to the various agencies, like let us say the mutual funds, the insurance companies, the PF funds, and even the retail. So that warehousing, for that you need a little bit of a liquidity. So at least that liquidity support coming out of the LAF will be most welcome. Your point of, let us say, that it hurts the RBI balance sheet of taking an asset which has a credit risk compared to the sovereign bond, which is default free, I tend to agree. But this is a measure which RBI is trying to do it to improve the underlying sentiment as well as the liquidity of the bonds. Once the liquidity of the bonds come into picture, then maybe this can be treated as high quality liquid assets under the 2A class of asset, and the banks will be more than willing to hold that for a HQLA for meeting their LCR also. So I think overall we look at this particular notification which is being coming out, I think it is worth doing this in the overall interest of the market development, because the risk to the RBI balance sheet is very limited, because over the 1% limit which they have set for LAF, I don't think the corporate bond will have more than maybe around 20 basis point or something like that. So I don't think there is a huge risk, unlike in the external scenario where the ECBs or the US, they have been buying bonds to a large extent.
That's
Here
true.
the amounts could be very, very limited. This is only a nudging theory that I would say that the bank is trying to do.
Harun, yes, it is true. All regulators really have a problem of balancing trade-offs. How much carrot, how much stick? And we see that in the context really of the corporate bond market too, where perhaps in a bid to increase volumes in the corporate bond market, the RBI has now issued directions capping the exposure of banks to large borrowers. The idea being that beyond a certain limit, large borrowers will have to raise money directly from the bond market. Should the RBI really be in the business of doing this? Because if indeed the corporate bond market is so much more efficient and corporates can raise money more cheaply there, they would automatically migrate there. So why is the RBI pushing them to do this?
You know, you see, wow, the whole business, if you go back to this cash credit system in India, and the whole very nice relationship of borrower and lender, relationship banking, quote unquote. So that there is a need for a lot of transparency, there is a need for a lot of better pricing, and there is a need for diversification of risk. And we have seen how over-leveraged corporates can contaminate banks' balance sheet and each feed to others' problems. So you have to solve the problem. Sometimes you have to do a bit of quote unquote again micromanagement. And in fact, it is in the interest of both corporates as well as the banks and the financial system as a whole that there is a risk diversification, and there is a need to do some regulatory nudging, be it so. So I think it has to be appreciated in that context, that in the overall financial stability we are taking the steps so that banks are not put under undue advantage, corporates have an additional avenue to go. They will have initial some resistance. Once it's like a chicken and egg, unless high quality corporates go to the bond market and bond market develops, you will always get into that chicken and egg syndrome. So I think this trade-off is worth taking.
Well, yes, it is a bit of a chicken and egg situation, but Venkatesh, are we putting the cart before the horse by trying to push the corporate bond market even before we have the supporting infrastructure in place? Today, the reality is that if a corporate defaults, there's very little recourse really for investors. Yes, I know the bankruptcy code has become law, but it will be at least 4 or 5 years before we have insolvency professionals, the insolvency and bankruptcy board in place, DRTs, the NCLT, and they've not proved very effective. So are we really putting the cart before the horse, Venkatesh?
I would tend to agree with Khansab when he is talking of that moving the corporate from the bank's balance sheet to the market. So it's we are trying to use the market mechanism to really find a solution for the corporate. The corporate default studies which are there, even at the highly stressful period, we will find that the corporate default studies of CRISIL or let us say the ICRAS or the other rating agencies is actually, I would say, showing not much alarming rise in default. There will always be some defaults in the corporate bond market, and with this insolvency code coming in, the bankruptcy code coming in, which will definitely take according to me, at least a 2 to 3 year time frame to come in, this this will have a little bit of a delay. But having said that, the time frame which is being given is up to 2019, 2017, 18, 19. So they are also putting a transition metrics when RBI has put out that guideline. So I'm trying to say that they are actually aligning it towards the Basel guidelines, so that when the Basel guidelines fully hit on 2019, the concentration risk in the bank balance sheet is partly mitigated with the large corporates actually going towards the corporate bond market to borrow. So it is not, I would say, the cart before the horse. I would say the horse and the cart are more or less in the same sort of direction. Maybe we need to push the horse a little bit ahead.
Yes, of course, but except that Basel itself is caught up in controversies. There's no agreement amongst banks in the world how exactly Basel should proceed. But Harun, the corporate bond market today is dominated by private placement and institutions. Will any of that change post these measures?
No, let me just add to what Venkatesh said about your earlier point. I fully endorse what he says, that there is a transition path given, and if you are wait eternally for that infrastructure to become sound and robust, you have to wait eternally. So I think all those recommendations have been put in place in terms of infrastructure and intermediaries. So I think we have to take all together. So there is a transition path. So it is not going to happen overnight. So but the direction is there. The other point is about, as you have also said in our report, we have also said that the entire insolvency and bankruptcy code implementation part has to be fast forwarded, and that's why we have said that I think government is committed to fast forward those implementations. So I think all of them will come together, and that will contribute in a manner to the development of the market.
Okay.
The other point is about predominance of private placement. Yes, 95-96% are private placements, and but what is now being suggested is a few measures so that people will move to public issuances. One, the liquidity improves, there will be incentive for public issuances, better pricing will happen, and even for the private placement, what you have suggested, and already it has been put in place, and it is going to be further fine-tuned, is sort of a repository where the private placement will happen on an electronic platform, so that there is a better price discovery, there is more transparency. So in that sense, it's a multi-pronged approach. And as I mentioned, you can't always think that this has not happened, that the other thing will not happen. You have to start somewhere. So I think this is what we have thought, that we should be taking steps in sync with a whole host of measures.
Well, Venkatesh, I seem to be the only skeptic around, but do you really see retail investors buying corporate bonds? We saw what happened to investors in the JP Morgan fund when Amtech Auto defaulted on its 800 crore debt. So would you really, put yourself in the shoes of an investor, would you really buy a corporate bond at all?
See, if you look at the retail investors' participation in the debt security, the retailing of government security itself is a challenge. That essentially where people buy the government securities and hold. So globally, if you see the participation of retail into the debt market, it is always through the mutual funds. So I think here also we should not keep a very high ambition of saying that the retail will come and directly buy the corporate bond or maybe the G-Secs for that matter. They will participate through the mutual fund, in the sense that they will give their funds to the able fund managers for them to manage the funds and give them a return. So to that much extent it will happen. The HNIs, yes, HNIs could come into this market, where even we saw when a tax-free bond was being issued by the corporates, the HNIs had participated. Where essentially even let us say for a return basis, maybe some of the non-banking finance companies, when they came out with some public issue of bonds, we saw a huge retail interest coming into that. So it is something which is a one-off sort of thing, but otherwise I will always say that the retail should participate through a mutual fund where there are able fund managers who can assess the credit risk and come out with a risk return profile for their fund, and based on that the retail investors should participate.
But as we saw in the case of the JP Morgan mutual fund, that itself is not necessarily an answer, but I'm afraid we've really completely run out of time. So even though we could continue this discussion much longer, I'll have to call it to an end. Thank you very much, Harun and Venkatesh, for joining me in this discussion and distilling some of the mystery of the corporate bond market for our viewers. To be honest, I don't quite share your optimism of the market, but I'd be happy to be proved wrong. But it is a fact that we need to look for alternate source of funds, especially for the infrastructure sector. Thank you so much, both of you. Thank you also for watching. watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.